please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
We will be getting you important guests as well as the creme de la creme of the UBS research team as well in the next 48 hours. For the moment, it's back to earnings season. Automotive Axles is the stock on our radar. It posted a very strong set of earnings in second quarter. Volume growth by commercial vehicle players led to strong revenue growth, and margins improved because of higher operating leverage. Gross margins were maintained. N. Muthukumar, President and whole-time Director, Automotive Axles, has joined us on the phone line. Mr. Muthukumar, good morning. Thank you very much for joining us. Well, it's an extraordinarily high growth in revenues at 53%. What is a maintainable quarterly run rate? 350 crores?
Good morning. Thanks for taking me in the call. It's always, as you say, the market is growing and we are growing then better than the market. That's the only reason. It's the work that we did in terms of launching the new products, launching to the new customers. So we are penetrating into the customer, radiating into the adjacencies, which makes us to always grow better than the market. As you see that, yes, the next 2 quarters looks very, very strong in the commercial vehicle market because of so many positive factors that is there. So we are very, very confident of maintaining the upbeat into the market.
So since the going is so good as of, as demand goes, Mr. Muthukumar, what about your capacities? Are you operating already at full capacity? Where are you? If you're full, do you want to add more capacity?
See, that's a good problem to face with when we are shortage of capacity, but obviously people find innovative ways of doing that. See, if you look at the H2 of this year, while it is looking at a very, very high number, if you look back from the year on year, we have not been that much of growth in the commercial vehicle. It will be a single-digit growth only. The first 2 quarters, the commercial vehicle industry saddled with BS4 conversion and GST into the system. Of course, we are running on a high utilizations and but that doesn't stop us in finding out innovative ways of production. We are geared up to meet the standard, the numbers that is expected from the industry, as well as we are also investing on our capacities for the future. But obviously, next 6 months, it's not going to come from the investment, but it's going to come from an internal efficiency improvement and innovations.
That is for the margins. But you've still not told us why this 50% jump in revenues. How much is domestic and exports in any case?
See, our exports have not been growing. It's about 7 to 8% of our total revenue comes from exports. Okay, it is purely a growth in the domestic market.
Exactly. So since we didn't hear so much about CV demand, how is it that you managed a 50% growth?
Why do you say that the commercial vehicle industry has not grown? If you look at the growth on the Q2,
well, the Ashok Leyland numbers told us that.
It's 14% growth when compared to the previous Q2. Okay. But whereas we have grown mainly because of we penetrated, our market share went up from 24% to 30% in this year. Okay. So penetrating into the market with the new products, and of course, agility in our business of meeting the demand of the customers is what to make most of the customers to come to us. I think that's what I feel the main reason for customers coming to us. We have prepared for this volatility. We have delivered them on time, a quality and reliable product, which makes the customers to come. That's why we are beating the market growth and we are growing ahead of it.
Sir, can you share the current capacity utilization level? I'm just going back to the capacity answer, and also whether these 11% plus margins are sustainable.
Absolutely. We are always under the pressure for the margins, where the commodity is looking up, the steel prices are going up. As you said, just before the crude prices is going up, our markets is always, our profitability is always going to be in constraint. But sustaining this level is going to be, we are very, very confident of meeting the number. But to your other question of our capacity utilization, we are at around 75 to 80% utilization now, and looking forward to gear up to the increased numbers.
Okay. Finally, how does FY 18-19 look to you? I guess at least the 18 order book will be already known to you. So can we expect this kind of a 350 crore run rate, or can it be even better?
If you see the shift in the commercial vehicle market, the product mix that was available a couple of years before is not there, no more there now. Okay, most of the people are looking at a cost-efficient or optimal cost vehicle, so the higher tonnage vehicles is going up. Even though we see commercial vehicles is increased only by 13-14%, in terms of tonnage, it has grown by 25% because people are moving into the higher tonnage vehicles. With that into consideration, definitely our revenue is going to grow. That is also one of the reasons. Even though the number of axles that we sold is not that much, the revenue has come because we have sold higher value-added axles. Okay, we see 18-19 is going to be a continuously good year with the government infrastructure coming up. GST is making it more easy for the automobile business to grow. We are confident of having a good, if not double-digit growth, the same higher of single-digit will be there for the next year too.
Okay, Mr. Muthukumar, thanks a lot for your time today. That's Automotive Axles. Stock's done remarkably well, of course, over the last 1 year. One stock which will be in focus is Westlife Development. Essentially, we're talking about McDonald's India here. That's in focus because McDonald's has high base prices to keep the overall prices same, but obviously there's an issue of GST benefit not being passed on to consumer. Amit Jatia, Vice Chairman of Westlife Development, now joins us on the phone line. Amit, good morning. So, if you could tell us that, we just compared two bills of McDonald's compared to last week and yesterday, and they're showing same prices post the GST. Is that going to be the norm, or have you done that for now and you'll make some internal calculations and pass on some benefit of GST?
Well, when GST came in July, we obviously got our menu prices right, and we were able to bring down and pass on all the benefits that were relevant at that time. And we made a bold move of going price inclusive because we had faith in the government that we are going to keep the same GST prices for a while. Now, very recently on Friday, there was a significant shift. And while we, of course, welcome the move of the government to bring down GST from 18 to 5%, remember that there is a spectrum of the restaurant industry, and especially for the organized players, the real cost is not 5%. Basically, the government, while bringing 5% down, took away the benefit of input tax credit, which for organized players like McDonald's, where we have invested over $200-300 million to set up supply chain in India, is bought through all organized players. So the impact of the input tax credit going away is 10 to 12%, which essentially meant that it was pretty neutral for us in terms of this new shift that happened on Friday. Yet, McDonald's has always priced its products at 30 rupees, 35 rupees, keeping in view the customer's affordability with or without GST. So, for example, very recently, after GST came in September and early October, we had launched our new Chatpata Naan burger, and the Chatpata Naan was priced at 49 rupees, including 18% tax. So it's not about GST or no GST. Fact of the matter is, with input tax credit, which was available to us for the last 20 years, has now been taken away, which added cost. Yet what we've done is, while the net gain to us was marginal, we've taken our iconic products like the Maharaja Mac, the Chicken McSpicy, the Maharaja Chicken Spicy, and the wraps, and we've brought down the price by 25%. Because when you look at an aloo tikki at 30 rupees, the marginal benefit to the consumer was negligible. But we took our iconic products and ensured that 25% of the price was brought down.
No, Amit,
so
I take your point. I take your point. I agree with that. The limited question I'm asking is that, I take the point that input tax credit is not being given. Net, because of this move, are you making more money than you were making, say, when the
That's
GST
exactly
was 18%?
What I said, that we don't, because previously you got to understand that when we were paying VAT before GST, for every food item that we were buying, we got credit for all the tax we were paying when we were buying from, say, McCain when it came to French fries, or from Vista when we were buying our patties or sauces and so on. Also, when service tax came in,
but is it entirely equal?
Amit,
the point is it, I mean, so completely perfect that, whatever was reduced, you've included in the taxes, was it so equal, or is there a sliver of margin you're making?
No, I mentioned that very clearly, that basically there was marginal benefit which we passed on through our iconic products.
Okay.
We, in fact, brought them down by 25%. And 25% of our iconic product like the Maharaja Mac and all reflects very well for the consumer.
Okay.
But if you look at, take coffee, right, or anything else, we are already 30% cheaper than the next competitor.
Okay.
And we've always kept our margins really tight, which is reflective in our results that we declare every quarter.
Okay.
So finally, Amit, then with this new regime set in, now 5% tax without input credit, right now, are you making any additional margin at all? If you can just share with us 10 basis points, 20 basis points over and above the previous regime.
Very clearly, the total input cost impact on us is 10 to 12%. 5% is the new tax. The marginal gain is about 1% or so, which we pass through the product shifts that we've made. And we did that yesterday. And our consumers are, of course, enjoying our new Maharaja Mac at 149 rupees instead of 200 rupees.
Okay, take your point.
So we feel though that input tax credit is actually a fundamental right for brands like us, and especially we've used registered traders. We do believe that whatever be the tax rate, we need to have the input tax credit available, and that would have not caused such a fundamental, shift in the consumer's mind when they view us.
Okay. Well, take your point. It's so now neutral for you. You're saying you just adjusted the tax and pushed up the price to include the input tax that you're not getting credit for. Thank you very much, Amit Jatia, for joining us.